Okay. Yeah, grind. We gotta knock this shit out. Boss man said we ain't got all day. Limber up a little bit, boy. Oh. Good job. They put out some motivational speaking. What is it? Bossman said I gotta work really hard and hurry up. He said I don't have all day.
The same level of earnings. By 1936, the stock traded between 111 and 131 until it crashed to 36 in the 1938 recession. Market misvaluation in 1938. The 1938 stock price of 36 was extraordinarily low, with the company valued at $126 million, despite holding $85 million in cash and $134 million in working capital. A&P was the largest retail enterprise in the United States, yet its market valuation fell below its net current assets, suggesting the market viewed the company as worth more in liquidation than as a going concern. This undervaluation was driven by fears of special taxes on chain stores, a drop in net profits, and a generally depressed market, factors that were either exaggerated or temporary.
How to get it done.
Investor perspective and market turnaround.
Oh, I do this teamwork so hard.
Stock in 1937 at approximately 80, 12 times the 5-year average earnings, would have seen the value drop to 36 in 1938. This decline, while significant, should not have prompted panic if the investors' analysis confirmed no substantial deterioration in the company's intrinsic value. Indeed, by 1939, the stock price rebounded to 170 yen, tripling from its 1938 low and surpassing the 1937 average. Long-term performance and overvaluation. A&P shares continued to rise post-1949, reaching an equivalent of 705 for the 1938 shares by 1961, following a 10-for-1 stock split. However, the 1961 valuation at 30 times earnings was driven by unrealistic growth expectations. This optimism was unfounded as subsequent earnings declined, leading to a sharp drop in stock price to 34 by the following year. By 1970, the stock hit a low of 21.5 and further decreased to 18 in 1972.
Dude, if you don't stop following me around, you're gonna have fucking problems, dude.
Lessons and investor takeaways.
Piss me off, bro.
Case underscores the volatility and potential
You need to stop looking at me, bro.
inherent in stock market. In 1938, the company was undervalued despite strong fundamentals, while in 1961 it was overvalued based on unrealistic growth expectations. Investors should note two primary lessons. Market prices and fundamental value.
Stop following me, bro. Who's watching me like this? I've had enough of you guys.
An investor's success often hinges on recognizing those discrepancies and acting accordingly. 2. Business evolution and investment monitoring. Businesses change over time.
You're pissing me off. He's always looking at me, moving around.
To ensure the company is fundamentally sound,
Oh, shit.
A&P highlights the importance of maintaining a disciplined, value-oriented investment strategy and avoiding overreaction to market fluctuations.
This is bad.
Investors are best served
No, I fucked it up.
intrinsic business values rather than short-term market performance.
Listen, was just in there. I should have left that guy. Jesus.
Mere trading securities. Commentary on chapter 1. Jekyll and Mr. Market. Happiness and wisdom of investing. Marcus Aurelius' quote: "The happiness of those who want to be popular, not others. The happiness of those
I
who
don't want to be popular. Fuck all these motherfuckers.
outside their control. The happiness of the wise grows out of their own free acts." Underscores the qualities of investing. Independence of thought and action. Business that is created when the stock market, as it requires an investor to remain detached from the capricious sentiments of others, often personified as the erratic Mr. Market. The myth of Mr. Market.
Did I already set these? Is that the problem?
Graham's metaphor of Mr. Market
think that's the
serves as a
problem.
compelling illustration of market psychology. Mr. Market is characterized as a manic depressive entity whose valuations of stocks swing between irrational exuberance and unbelievable. This personification helps investors understand the importance of not being swayed by
You watch your mouth, boss man.
rather focusing on the intrinsic value of stocks. The narrative of Inktomi Corp, whose stock soared to irrational heights only to crash precipitously, exemplifies Mr. Market's volatile nature. The Inktomi Case Study. The rise and fall of Inktomi Corp in the early 2000s is a vivid case study of market mania. At its peak, despite chronic unprofitability, Inktomi was valued at $25 billion due to Mr. Market's irrational exuberance. This bubble burst spectacularly, with the stock plummeting to a fraction of its peak value. This stark fluctuation highlights the disconnection between market price and business fundamentals, illustrating the follow market sentiment blindly. Learning to think independently, investors often succumb to Mr. Market's mood swings, adjusting their behavior based on market highs and lows. This herd mentality can lead to poor investment decisions, reducing contributions to retirement plans when stocks are cheap and increasing them when stocks are overpriced. The key takeaway is the importance of independent thinking and the discipline to resist the crowd's irrational behavior. Harnessing Mr. Market's volatility. While it is crucial not to follow Mr. Market blindly, it is also important not to ignore him entirely. Intelligent investors should use Mr. Market's
Too old for this shit, boss man. You guys need to find some young bucks out here. Do this shit quick. Like I used to be able to, boss.
Mr. Market from a master into a servant, where his mood swings provide opportunities for astute investors.
I ain't as good as I
Professional
was.
investors versus individual
As good
investors.
as
Professional investors face
All right,
constraints
brother.
that individual investors do not,
Oh, now.
such as the need to match or beat benchmarks and manage
Have
large
some
funds,
tequila and
which can
that
lead to suboptimal
little
investment decisions.
lemonade, boy.
Individual investors have the freedom to think long-term, diversify, and avoid the pressures of short-term
Some paint
performance
down,
gains.
slipper.
By focusing on controllable factors, costs, risk, and
Up and
behavior,
down.
individual investors can potentially achieve better outcomes than professionals are often forced to follow market trends. Psychological challenges and behavioral discipline.
The fuck you are.
Investors' brains are wired to seek patterns and react emotionally to gains and losses. This tendency can lead to irrational behavior, such as chasing after rising stocks or panic selling during downturns. Understanding this psychological predisposition helps investors practice
Up and down.
behavioral discipline. Strategies such as dollar cost averaging and maintaining a long-term perspective can mitigate the impact of Mr. Market's fluctuations. Embracing market downturns. Contrary to common fear, market downturns present opportunities for long-term investors to buy undervalued stocks. By adopting a mindset that views falling prices as buying opportunities rather than losses, investors can benefit from market cycles. This approach aligns with Graham's teaching that stocks should be viewed as part of a long-term strategy rather than short-term speculation. Tax strategies and loss harvesting. One practical strategy during bear markets is tax loss harvesting, where investors sell losing stocks to offset gains and reduce taxable income. This tactic not only helps in managing tax liabilities, but also provides an opportunity to reinvest in the same or similar stocks at lower prices, effectively benefiting from Mr. Market's irrationality. Investment discipline and long-term contracts. To solidify this disciplined approach, investors can use an investment owner's contract to commit to regular, long-term investing, resisting the urge to react to market volatility. This contract emphasizes the importance of consistent investment, regardless of market conditions, and reinforces the commitment to a long-term financial plan. In summary, Chapter 8 provides a comprehensive framework for understanding market psychology, the pitfalls of herd behavior, and the strategies for maintaining independent, disciplined investment practices. By learning from historical market episodes and applying behavioral finance principles, investors can better navigate the complexities of Mr. Market's moods and achieve their financial goals. Chapter 9, Investing in Investment Funds. Introduction to investment funds. Investment funds provide an accessible option for the defensive investor. These funds, which pool money from numerous investors to purchase securities, come in two primary forms. One, mutual funds, open-end funds. Shares are redeemable on demand at the net asset value, NAV. These funds actively sell additional shares through sales teams. 2. Closed-end funds. Shares are non-redeemable, with a fixed number of shares that trade on the market like regular stocks. Both types are regulated by the Securities and Exchange Commission, SEC. Size and
I need to get out of
classification.
here.
As of the end
There
of
ain't enough room on
1970,
this job for
there were
both of us.
383 registered investment funds with total assets of $54.6 billion. These funds can be categorized by their portfolio composition and investment objectives. Balanced funds, significant portion in bonds, about 1/3. Stock funds, predominantly common stocks. Other varieties include bond funds, hedge funds, etc. Funds can also be distinguished by their sales methods. Load funds include a sales charge around 9% of NAV. No load funds, no sales charge, relying on management fees. Tax treatment and fund structure. Most funds operate under tax laws that prevent double taxation, requiring them to distribute nearly all their ordinary income and capital gains to shareholders. Some funds have introduced dual-purpose structures with separate classes for income and capital gains. Investor considerations. Investors face a broad array of choices, raising several critical questions. 1. Can the investor achieve better than average results by selecting the right funds? 2. How can the investor avoid funds that underperform? 3. What are the merits of different types of funds, e.g., balanced versus open-end versus closed-end, load versus liquid? Industry performance overview. The fund industry has generally served investors well, promoting good investment habits and providing returns comparable to the overall market. For the average investor, mutual funds might have provided better outcomes than direct stock investments, despite similar aggregate returns and potentially higher costs. Fund performance analysis. Analyzing the performance of the 10 largest stock funds, 1961 to 1970, reveals that they performed on par with the Standard & Poor's 500 stock composite average and better than the Dow Jones Industrial Average, DJIA.
Told you stop following me around,
Variability in
motherfucker.
individual fund performance underscores the difficulty in selecting consistently
I'll throw
superior
something at
funds.
you.
The rise and
Yeah,
fall
you,
of performance
dude.
funds.
With the
The
camera.
1960s saw the emergence of
I'm
performance
trying to
funds,
fix your porch.
managed with a focus on achieving
Motherfucker.
exceptional returns. Initially successful, these funds eventually faced significant losses due to speculative investments and inexperience among young managers. The Manhattan Fund exemplifies the risks with dramatic initial gains followed by notable declines and investments in companies that later faced bankruptcy. Investment strategy recommendations. Investors are advised to be cautious of funds that promise extraordinary returns. Long-term, well-managed funds typically provide stable, though not spectacular, performance. Closed-end versus open-end funds. Closed-end funds often trade at a discount to their NAV, offering
What's up,
potentially
dude?
higher returns compared to
You want to
open-end
keep
funds
playing with me,
sold
dude?
at
You guys can.
Despite concerns
Just like,
about price
share, and
fluctuations,
subscribe.
historical data suggests that
Motherfucker.
closed-end funds can provide superior returns when bought at a
All
discount.
your asses.
Balanced funds. Balanced funds, which hold a mix of stocks and bonds, offer lower income returns compared to direct bond investments. Investors might achieve better results by separately managing their bond portfolios with high-quality bonds or tax-free bonds. In summary, while investment funds offer a range of options for defensive investors, careful selection and a clear understanding of the different types and their performance histories are crucial for achieving satisfactory results. Commentary on Chapter 9, Insights into Mutual Fund Investing. The introductory joke in Chapter 9 serves as a humorous yet insightful preamble, emphasizing practical knowledge over theoretical understanding. Milton Bob's understanding of his sheep, despite his poor grasp of subtraction, parallels the core message of the chapter. Practical, experiential knowledge in investing often trumps theoretical expectations. Mutual funds, almost perfect investment vehicle. Mutual funds, a quintessential American innovation introduced by Edward G. Leffler in 1924, have democratized investing. These funds are characterized by their affordability, convenience, professional management, and stringent regulation under federal securities law. They have significantly broadened participation in the investment world, enabling millions of American families and global investors to engage in the financial markets. However, mutual funds are not without flaws. Their imperfections often lead to underperformance relative to the market, high avoid potential pitfalls and ensure their investments align with their financial goals. The misguided pursuit of top performers. A common mistake among investors is chasing after funds that have recently shown stellar performance, assuming this trend will continue. This behavior stems from an innate human tendency to believe that short-term success predicts long-term outcomes. However, in financial markets, luck often plays a more significant role than skill. The chapter illustrates this with the example of the hottest funds of 1999, which eventually underperformed, highlighting the inherent unpredictability of market sectors. The folly of relying solely on past performance is underscored by academic research indicating several consistent findings. Most funds fail to pick stocks effectively enough to cover their costs. High expenses correlate with lower returns. Frequent trading diminishes earnings, and high volatility persists. Thus, choosing future top-performing funds based on historical performance is nearly impossible, akin to expecting Bigfoot to appear at a social event. The intelligent approach to mutual fund investing. Understanding the difficulty in finding consistently good funds helps investors make more informed decisions. Despite the challenge, certain strategies can improve the odds of selecting beneficial funds. 1. Managerial investment. Funds where managers or significant shareholders align the manager's interests with those of the investors, reducing conflicts and enhancing performance incentives. 2. Low expenses. Funds with low operating costs tend to perform better over time as high fees erode returns. 3. Unique strategies. Funds that adopt distinct investment strategies diverging from the mainstream often outperform by capitalizing on overlooked opportunities. 4. Capacity constraints. Funds that close to new investors at appropriate times avoid asset bloat, which can compromise performance. 5. Low advertising. Funds that do not aggressively market themselves often focus more on performance than on gathering assets. Index funds. A reliable alternative. Given the difficulties inherent in active fund management, index funds, which aim to replicate market performance rather than beat it, offer a robust alternative. Their low costs and passive management style make them attractive for long-term investors. Despite their lack of excitement, index funds' cost advantages compound over time, leading to superior performance compared to most actively managed funds. Risks of overconfidence and short-term focus. Investors' overconfidence and the tendency to make short-term decisions based on recent performance can lead to suboptimal outcomes. Historical data shows that poor-performing funds rarely become winners, and emotional reactions to market fluctuations often result in buying high and selling low. Therefore, maintaining a disciplined, patient approach is crucial. Closed-end funds and exchange-traded funds, ETFs. While closed-end funds have diminished in popularity, they can still offer value, particularly when trading at a discount. ETFs, on the other hand, provide a modern alternative, combining the benefits of index funds with the flexibility of stock trading, albeit with considerations regarding transaction costs. When to sell a fund. Deciding when to sell a fund should be based on clear indicators, such as strategic shifts, rising expenses, high tax liabilities, and erratic performance. Investors should avoid making decisions based on short-term underperformance, which often reflects temporary market conditions, rather than a fundamental flaw in the fund strategy. Conclusion. Chapter 9 offers a comprehensive examination of mutual fund investing, blending practical advice with
That's why I don't just rip this entire
emphasis on low costs,
corner.
unique
I guess
strategies,
it's
and managerial alignment, coupled with a cautious approach to past performance, provides a solid foundation for making intelligent investment decisions. By prioritizing long-term discipline.
Okay, shut up, please. I have a potty. Ricardo? Is that what you told me, boy? You got work. Where's your dada go? No. That's a dog. Oh, that guy? I'm glad you guys are over here in the shade. It's hot over there, boss. Boss man, like you don't have a portable air conditioner to put in you? You're saying it's hot. I usually just kind of wait up. I shouldn't have drank milk and ate spicy ramen last night at 2 o'clock in the morning. No, I'm alright. I just gotta leak it out a little bit. You know what I mean, brother? You know what I mean? Just gotta leak it out just a little bit. Maybe I'll do this. So get it. Yeah, did something. Maybe if I smoke enough cigarettes, it won't bother me so much. You know what I mean, brother? I'll be right back. Don't follow me. Oh, God. Ah, that's gross. Yeah. How does he keep on going? Just gotta keep puking it out. I keep puking all the milk. I ate too much milk. It's really bad. Oh. Yeah, it's painful. Alright, I'm gonna go ahead and sell now. It's quite a substantial amount of money right there. Alright. Oh, yeah, that's a good part. Alright, now that's a sneaky part. I was just too old for it. I gotta quit. I quit. Maybe if I smoke a cigarette, I'll be alright. Yeah, I'm good now. Oh, hell. Hot. Be a carpenter, they said. It'd be fun, they said. You can do so much stuff. Ah. Ah. Fuck that shit, dude. Ah, poop. I gotta poop. How am I supposed to poop out here? I poop like a bear? I poop like a bear. I gotta poop and pee. This is really bad. I gotta go potty. I gotta go potty, chat. I gotta go potty. I gotta potty. I gotta go blow out